Sal's question is related to the credit spreads. And I might have to go back to my other account. Oh, no, I just wanted to be on the main page. I'm sorry, folks. Okay, Bull put credit spreads. Sal says, on credit spreads, could there ever be a risk of exercise after 4 p.m. on expiration day? The answer is yes. But he goes on and says, in other words, could there be scenarios where options are out of the money at the same time of the market close, but end up in the money after hours due to a large stock price movement where the option gets exercised? Is a smart thing to do to always close the short position just prior to the 4 p.m. expiration? If you're that close, yes. Okay. If the spread had fallen in price, and let me pause the screen real quick. We're going to take a look at one of my examples here. But I have to go onto my account. I'm on the webinar account. I'm going to quickly go back to my account, which I normally don't like to do in this case. But I didn't watch it at the end of the day because I was waiting for my triggers to go. I know you're not seeing it yet. Give me 1 second. All right. Oof. 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 Rough day. Rough day. All right. So what is Sal talking about? Here are the bull put spreads I opened on Monday and another one actually that I opened up today. And ignore the cost basis. This goes along with that conversation for Chuck where I'm showing the risks from last week. This is going to be used in the presentation of why it's risky to use certain leveraged strategies, starting off with 1,000 or just putting $1,000 into, say, hey, I want to trade 2 or 3 options positions. Where's the risk in? One of the big risks inherent right now for me is this IBM position. I'm not trading this in just $1,000 account. I'm not doing just one contract of this position. That's for illustration purposes, but it is a trade I'm in. So on Monday, with the stock at 136, I think, or 137. Let's just see here. I can't remember what the stock price was at the time. 137.40. Okay. I opened a bull put credit spread. All right. Sold the 131 put, which had the 85% probability range out of the money I want, for 131 for 76 cents, excuse me, and bought the 129 for 53 cents. I was searching for a little bit more. I was looking for a 14% return. I didn't get the price that I wanted with the midpoint juggling, so I settled for 13% on this position. Again, this is not just a one contract trade, but it's 23 cents on a 2-point spread. The stock has since moved down 5 or 6 points. It's trading at 132.69. My 1% stop is at 132.30. Check here on my notes. Yesterday, here's my entry, and yesterday at 2:10, first warning, 8 days to expiration, stock fell below the SMA 20. MACD just turned slightly negative, but stock was not at the 1% stop of the 131 strike, 132.30. If it's hit, I may consider rolling down the strike, going from the 131 to the 130, one of the 8 ways we manage a bull put, for example, or converting it to a bearish spread. I'm tracking this exactly how I track the real position in my portfolio, even though we're using this as an illustration. But see, if I did open all 4, even though this one was open today, but if I did open all these 4 positions for the next cycle, 7 and 14 days out, it would have taken up most of my buying power. And if I have to buy to close this short put, it's getting really close to at the money, I don't have the capital to do it. Right? I have to finagle a different way to close one of these positions that's maybe at a profit that's under 90 cents, and none of them are. That's where this one rule becomes tricky. Let's take a look now at something else. Company info news is usually the best place to see it. It updates more than the stock chart there. Oh, sorry, folks. Let me get that out of the way. Okay, so it went up 11 cents, so it's not as bad. But if this had dropped down to say 131.20 after hours and moved down 11 cents and moved a little bit lower, I could be concerned. And I would consider buying it back. Let's see here. Okay, let me go back to custom spreads real quick. And I'm just going to plug this in so we can really fully answer questions, Sal. I just wanted to give some of that rules there and some of those ideas. But let me take a look here. Perfect, perfect, perfect. Not today, but let's take today. Sorry, folks. Let's say that I had a few days ago, a few weeks ago, 10 days ago, entered a bull put credit spread on Tesla, and I sold the 860. I'm going to use fake numbers because I don't know what the prices were. Okay, so let's say I sold this at 2, and I bought this one for 145. 55-cent net credit on a 5-point bull put credit spread. And here we are with the stock at 860, right at the strike price, and it fell 44.55 today. Now, normally, Sal, you've heard me say that I'll close a position if, as I mentioned with IBM, that's flirting with that. If this hit the 1% rule, in other words, if this dropped down to 863, and my other triggers, 2 triggers were hit, seeing a negative stock dropping below the 20-day moving average, negative MACD, what other technicals I use to get into the position. I'm sorry, 868. 868. Sorry about that. That's my 1% rule to the short option strike. Okay. So when Tesla started falling today, this is today's, let's say it was today's expiration, and I'm in this position. I am looking to close this position. If it moved down gradually at the end of the day, or in those last 2 hours, which most stocks did today, unfortunately, we'll take a look at the daily chart of Tesla in just a moment. Then at 3 o'clock or 3:30, I was probably really looking to close this position, at least the short option, because I don't want to be assigned. I didn't get into the bull put credit spread to potentially buy shares of stock. I'm just doing it to get income in that case. All right. So yes, if you're within 1%, maybe even 2% near expiration, if you can close it for a profit, I would do it. If you close it for a slight loss, I can do it. The reason I'm using Tesla is that about 2 years ago, during the heyday of all the Reddit traders and all the new traders coming in, there was a gentleman, I don't remember his name, I don't think it was Tony Zhang. Many of you might know he's the guy that's CNBC, I believe, or MSNBC, talks from there. Great guy, great educator, don't get me wrong. He heard a story, and I think it was one of his users or one of his followers on YouTube or on his channel, or that had called into the show. And I don't remember the exact strikes. He was in a wide spread. It wasn't this close. If he was in a 5-point spread, he probably would have been fine. But he was in a wide spread of about 40 or 50 points. Let's say he sold the 1,000 put on Tesla, and it might have been 50 or 60. He bought the 950. Okay, so he was 50 points apart. The stock was closing. It closed, and it was expiration Friday, and it was around 1020. This might have been 1200. I don't remember. But in any case, the story goes that shortly after the market closed on that Friday, Tesla fell from 1020, and in the first 10 minutes was trading at around 960. Something to that nature. It lost 140 points. And the investor was assigned, it was a reasonable, significant number of contracts too. I want to say it was 40. I can't remember. But he thought he was safe, that it was going to expire worthless. Tesla had a huge drop, and it ended up below the short put strike price in the first, it might have been 10 or 15 minutes, maybe even less, maybe 5 or 10 minutes. And the clearinghouse closed him at this price, or exercised, excuse me, Sal. He was forced to buy the 40 contracts worth at whatever price Tesla was for this insane amount of capital. And then something even more odd happened, which has never happened to me, and I've never heard of it until this. In the next 10 or 15 minutes, Tesla went further and dropped down to, say, 910, 905, some insane number. And his broker's giving him all these notifications, emails, phone calls, apparently, about how he has a huge margin call that he can't afford because Tesla's now at 910. And the guy said, okay, well, I had enough to cover it because I was in a bull put. I covered the 40 contracts with the 950 put. And apparently there was some notion that in the first 10, 15 minutes when it went here below the 2 strike prices, the clearing council closed this, but the further drop after was after they had already let this expire. So the 950 couldn't have been used. So he's now looking at a $90 loss of shares he can't buy on 40 contracts or something along. The numbers were insane. I have never heard of that before, and I don't think I've heard of it since then. The key is, of course, is to remember that yes, after market moves can happen. That's the most extreme that I've heard on a Friday was what happened to Tesla at that time. If you're worried about it, and if you're in 0.5% or 1% of the short put strike price, the last half hour to expiration, if you can close it for a gain, I try to close it for a gain. Okay. Even if it's not what I expected. And the reason why is because I don't want to watch it for the next 10, 15, 20 minutes. And normally on a Friday, I can't because I'm getting ready for our sessions here. So I want that out of my mind and out of my head and not taking the chance that, yes, it could fall 1.5% in the after hours before that 10, 15 minutes clearance bubble, whatever it is, or 45-minute clearance bubble. And then I end up getting a sign on the shares. In that situation, I will. If I'm 3% out of the money, 2.5% of the money, maybe even 2% out of the money, I'm usually okay to take the chance to leave it open. Because again, this hasn't happened to me that often, where on a Friday after the market, this just went. The risk is there, Sal. Main key. Remember, bull put credit spread, bear call credit spread. Just because you're in a spread position does not mean that you remove the rights and the obligations of the sold option, or if you're in an iron condor. If the stock falls below that short put, you still have an obligation to buy X amount of shares at that price. Whether it happens after hours on a Friday, whether it happens after hours on a Tuesday, that is still a potential obligation. Yes, if it falls below both strikes with a large movement, you're covered. Okay, most likely. That Tesla example we were talking about is the only situation I've heard about that this has happened. If you've got another story where this has happened to you, I'd love to hear it. I feel bad for you and I don't want it to happen to you. But if you have a story like that where some kind of movement happened where you were assigned and then later it still fell further, but they didn't exercise your long to deliver the short, I'd love to hear that. Okay. But again, your obligations are still there. So if you're in a bull put, bear call, iron condor position, and as you're getting closer to that last hour, that last half hour of expiration, and the stock is flirting with your short option strike price, and you're just hoping and hoping that, hey, at 4 o'clock it closes below my short call or above my short put. You do know in the first maybe 15 to 20 minutes, if there's anything else that goes wrong, it could be here. You're in that 1% rule. Close it. Try to close both, because you don't want to just take zero value or just pay into the short put to buy it back, because that might negate any net credit you receive depending on where the market maker's pricing it. So that's my advice, Sal. There's nothing wrong with closing early if you're concerned. Usually if it's under 2%, I consider it. If it's under 1%, I absolutely consider it. If it's at 3 or 4%, I feel okay. Because again, luck, circumstance just hasn't happened to me where there's a big movement after hours. So let's say that we had the 860 February 4th and 855 February 4th bull put credit spread on Tesla. We had entered it today. The stock ended right at 860. And in the last 10, 15, 20 minutes of the market, dropped down to 858. That's the risk. Once I saw it go to 868, 867, even on the last day, that's when I'm looking. Yeah, it would have been right about, it was this last fall off that I was talking about, right about here, 1:56 p.m., 2 p.m., 868, 77. And then it's kept going down and came back up. Hopefully I got it here, maybe not. But yeah, at this point, I'm buying it back. It's not worth the risk at this point. Oh, sorry, folks. It's not worth the risk at that point. And it went below. So I definitely would have closed here if I could, or here even if I missed it. Maybe got lucky. But yeah, I would have been out of this position, Sal, of course, beforehand, once it hit that mark on the trade as it started to decline in the last little bit. Oh, no, Sal. So I don't have the intraday time, minute by minute time on that Tesla option right now. Sal says, just to confirm, you close out early, the max loss can't ever exceed the original max loss, i.e. the spread strikes less the credit, right? Absolutely. Towards the end of the day, and I can't see it here, this might have been pretty expensive, but it wasn't probably 445. Now, that being said, let's go back to here. I know it's not the best view, folks, on that chart, but I want to bring it back up. Oh, I'm sorry. I want to go to news. Here we go. Okay. Max risk was what we saw, 445. At this point, when the stock was at 853, 854, it would have cost me $6 to buy that short put, wouldn't it have? At least. That's intrinsic value. When we sold the 860, it's going to cost me $6, $6.40 to buy it back. But I also have the 855, Sal. Okay. So with the 855, trying to sell to close that for at this point, maybe $2, I'm still in that range of the 445. Okay. And if I don't get filled and it stayed below both strike prices, yeah, I could lose more than that case. But again, even if the stock's between the strike prices, well, remember, if you get put the stock, Sal, that's a different story. I'll talk about that in a moment. But see, here, even at 853, if I just bought to close the short and then the stock went back up to 860, you're right. If it cost me $7 to close the put here, and I only took in that 55 cents initially, my loss is at 645. Well, I'm expecting the stock to continue down, and I want to try to sell to close my lower strike put to kind of counter more of that loss. But if it went back up and that put goes to zero, I now have a larger loss. If I'm at a point where I'm on the day of expiration and the stock is moving below my short put strike price, it went below the 1% and it's still going down, I'm closing both legs. And in closing both legs, the loss will never be more than the 445. However, if you just buy to close the short for the higher price, and then the stock recovers and moves back up and you can't get as much for the now further out of the money put that's expiring today, you could lose more. If the stock ends up between the strike prices on that after hours move, Sal, and I get assigned the stock and I have to buy 100 shares at 860, and on Monday, Tesla opens up at 851, now I'm at an unrealized 9-point loss, which is more than I could have lost on the spread position. If you close out both legs together, minimum debit to close the spread, even in those situations on the last day, with the movement we saw today, you should not be taking more than the maximum loss ever. Okay? And if you do, if there's a wide bid-ask spread, maybe take 10 cents more, but it shouldn't be exceeded. And if it's below both strike prices and you can't get filled to close it, if it's staying below both strike prices, maybe just leave it open, let your broker exercise and assign, and now you've known you've taken the maximum loss on the position. Okay? All right. So that's what I have for that there on the spreads. Again, good idea to close it early. If you're too close to the price, you're in that 1% range or so, and coming into the earnings, you should be able to close it out for less than the maximum loss on the position, absolutely. But you have to close both. You can't just close one and hope that the other one gains more money, because that's how you outthink yourself in those positions. But closing both, Sal, is also better than having it go between the strikes, getting assigned, and then Monday seeing the stock fall further to now you're in a larger loss because you're short. You bought a bunch of shares of stock, and now you have to sell at the market, and the stock's falling further than what it was beyond the maximum risk on the position. I think this is related to our last discussion a little bit. Fernando adds a comment. He says, just to share, last week I was assigned on a sold put on RACE, and the put was out of the money. So Ferrari here, we're at the 218, 220 range. Last week it might have been at a different price. Let's look at today's expiration, 218, 217. So Fernando says he was out of money. So what he means is he was holding a 217.50 put, and the stock was at 218. The bank told him, in Italy, the bank told me is assignment exception. The first time in my life after 1,000 trades. I did not know this was possible, but it is. Okay. So yeah, I don't think that has not happened to me before, Fernando, either. I don't know if this was an after hours issue that Sal was bringing up, but it's important to know that close in, and they call it the assignment exception or exception assignment there. In that case, that might have been what happened to the race position. I'm just taking a look here. I've been interested in not where I want. Oh, let me go back to this one. Ooh, sorry. I've been thinking about this for a while. I've been thinking about looking at these positions or potentially some of the Porsche slash VW positions while expanding out into the European car market a little bit. But that's a decent, I like that return for 7 days. I don't know if they have earnings coming up. I would check that too. Just a thought I had recently with some extra capital lying around. Oh, nope, 5-4. Okay, perfect. In any case, I'm just curious about that because I've thought about it recently and I haven't checked their prices. So, important tip from Fernando. In Italy, they called it the exception assignment, which I have not come across. I don't know if it was a similar thing, Fernando, where the after hours there, you were at the money and the after hours pricing, as Sal was concerned about, dropped and it went below the price and you got exercised in that case. And then the next day it might have been fine. Did we move any in the aftermarket here? About $1.66. So that $217.50 would now be in the money as well. So that might have been a case that was pretty similar.